right, let's talk about GDP. India's gross domestic product grew at 8.4% in the second quarter of this financial year. That means between July and September. So this figure shows a significant improvement compared to the second quarter of FY20, where we shrank 7.4%. So the increase, one must remember, is on this very low base when we were still emerging from the effects of the lockdown and the first round of COVID-19. Nevertheless, the internals and the details of the GDP numbers do show a steady recovery, even as vaccination rates have begun to increase and even as infection rates began to decline in the second quarter of this year. Listen in to what the Chief Economic Advisor had to say about it.
India is likely to have double-digit growth, in this year. The overall growth for the first half has been 13.7%. So even a little more than 6% growth in the subsequent quarters should be able to deliver double-digit growth for this year. And we are projecting 6.5 to 7% next year, and thereafter 7% plus.
All right, let's go across to our panelists on what they make of the numbers this time round. Aditi Nayar, Chief Economist, ICRA on the show. D.K Joshi, Chief Economist, CRISIL, speaking with us this evening. Siddhartha Sanyal, Chief Economist and Head of Research at Bandhan Bank, also joining us. Welcome to all of you, and thank you for speaking with us on the India development debate. Aditi, let me begin with your take about whether we truly are showing signs of robust recovery. Of course, 8.5% looks great, 8.4% looks great as a number by itself, but it does come on a low base.
Well, Tamanna, 8.4% has come in higher than what we were expecting. But when we look at the internals of the GDP number, if we disaggregate it into its components and compare each component to the position in Q2 of FY20, the internals really don't look that great. And that's my main concern as far as the number is concerned. It's definitely higher than what we were expecting, but the breakup isn't very meaningful in terms of giving us a clear signal about the durability of the recovery. Why I'm saying that is because both the private final consumption expenditure and the government final consumption expenditure are lagging the Q2 FY20 level. A good bit of news is that the gross fixed capital formation is higher, but just about by 1.5%. But what's significantly higher than Q2 of FY20 is a component called valuables, which is perhaps correlating with this sharp jump in gold imports that we've seen in Q2 FY22 as compared to both last year as well as the pre-COVID period. And if that is indeed the main driver of the marginal increase in the overall level of GDP in the quarter that's just completed as compared to Q2 of FY20, then that's not a very meaningful sign of a domestic demand recovery that is durable, or that we can expect will, it's not a sustainable base for us to project how the recovery is going to pan out going forward.
Mr. Joshi, do you share these similar concerns that overall the headline number looks decent? The Chief Economic Advisor also said that don't, underestimate it just because it comes on a low base. We'll be seeing that, of course, for some time. Perhaps from next quarter, that base effect will reduce significantly. But when you come to the details, does it seem that India's growth may not be as robust as the high-frequency indicators were showing?
I think I would look at it in this manner. If you notice what has been happening over the last 6 months, people have been revising up their growth forecast. So which means that whatever recovery was expected and what we got is faster than what people were expecting earlier, and that has led to so there is a positive surprise, I would say. I think of late, of course, the high frequency indicators were showing that the recovery is strong. I think also you should note that this is despite some hiccups from the supply side and high commodity prices. And I think you got a positive surprise to growth despite, I think, the bottleneck, supply side bottlenecks. So I think that to me is a positive element, I think, in this recovery. Now, I think this was, of course, the manufacturing hasn't performed that well, and some of the slack has been picked up by the services sector, because services is operating on a very, very low base. So I think that is giving some momentum to the GDP. And finally, I think the export performance has been quite stellar. I mean, the exports as a percentage of GDP were 19.4 in 2019-20. Today, in the first half, they are 23.5%. So I think overall, there has been a positive momentum from exports, although I think unlike last year, the imports are also very, very strong. So I think the trade is not contributing net positively to GDP. But nevertheless, I think higher exports means they support economic activity at home. So that is one way to look at it. Now, I think what would worry me is the fact that one, government is still supposed to play an important role in the recovery. The government final consumption expenditure as I think as a percentage of GDP, or the momentum in it, I think is not very strong. So government consumption is weak. That I think that is to some extent is made up by government investments, which is keeping the overall investment cycle relatively stronger. The biggest worry to me is the private final consumption part, which is about 55% of GDP. If I look at on a historical context, the private consumption to GDP ratio was around 57 in 2019-20. It fell to 56 last year as a percentage of overall economy. And in the first half of this year, it is 54.8, which means that private consumption is trailing the overall GDP growth. And I think we all know that for capacity utilization, etc., to go up, you need a momentum in private consumption to pick up. And I think that is what I would be looking out for in the next couple of quarters. And I think then I think there are other issues like Omicron, etc., about which we really don't know much at this juncture.
Yeah. We'll come to Omicron, we'll come to inflation, because let's not leave that out in terms of future challenges. But I just wanted to first get a basic sense of these particular numbers. And Siddhartha Sanyal, your take on the private consumption numbers and whether you feel they haven't rebounded to the extent they could have. And would that also have a lot to do with the fact that petrol, diesel prices were high, costs have been going up, and there were supply chain bottlenecks as well?
Yeah, that's very true. And I think both Aditi and Dr. Joshi both mentioned it, some of these facts in a few different ways. So basically, if we see one very important indicator in case of private final consumption expenditure is the consumer confidence index. And if we look at the consumer confidence index, there has been some recovery to it of late from the lows of if I look at the urban consumer confidence index that the RBI publishes from the lows of sub 50 that was hit about a year back. The number, that particular index has moved a little higher, but a little higher to the extent by about 10 points or so. In the mid 50s, the consumer confidence indices are still way lower compared to the 80 plus or 90 plus kind of zone where they used to be in the pre-COVID time. So still, consumer confidence indices, whichever index you pick up, are good 25 to 30% lower than the pre-COVID period. So, and it's quite some time that the index is actually languishing there. So there is no indication that consumer confidence will be jumping up very soon in a rapid fashion to provide a big tailwind to growth recovery from this particular side. And very important is that this particular driver in this particular quarter, we have seen quite a bit of strong component from the export side, which is really heartening, but we have to see whether it holds up in the coming quarters also. But private consumption, which is typically 60% or even at times 2/3 of the overall growth momentum or in terms of growth contribution, they continue to languish a bit, and there is no clarity that will be that will be moving higher significantly anytime soon. Now, whichever number I was talking about so far is departing to the urban consumer confidence index. My sense is that at this juncture, rural consumer confidence index can actually be slightly weaker rather than, compensating for the weak urban consumer confidence index. So overall, the story remains somewhat weak on that particular aspect.
In fact, Nielsen numbers are out today on rural consumption of FMCG, and we'll put those numbers out as well, and they are showing a weakening as well. But, this is at the end of it Q2. Aditi, I want to understand from you your perspective on what Q3 could look like. And I'm saying this because all of the commentary, high frequency indicators, anecdotal evidence around consumption in Q3 has been phenomenal so far. Expenditures are back, high ticket items were selling briskly, the whole festive season mood, etc. Do you think that will convert into a different perspective as far as the Q3 numbers go?
I just want to give a little preface to what I'm going to answer in terms of responding to your question, and I want to just pick up from something that Siddharth said as well. If we go back and look at the Q2 numbers, there are three subsectors of the GVA which had growth which was lower than our forecast. And those are manufacturing, construction, and the trade, hotel, transport, and communication subsectors, which actually ended up disappointing, even though the overall GVA number was higher than what we had penciled in. And for manufacturing and construction, I believe that the volumes having been what they were is a margin hit GVA growth for these subsectors. And if we look ahead into Q3, sure, the mood is great. The festive season was mostly quite positive, other than the auto blip. But that's more because of supply side issues, at least for the big ticket PVs. But really, what we do have, evidence of is that the price hikes are now going to widen as the demand recovery becomes stronger. Producers just aren't going to be able to hold on to their final prices anymore, and input costs are going to get passed through, and that is something that is going to have some containing impact on the overall revival in demand going ahead as well. So I would say that between demand and input prices, they're going to offset each other a little bit. And therefore, the kind of GVA growth that we get for some of these subsectors may not be spectacular in Q3 or in Q4. And of course, the new variant, the Omicron, is something that we need to watch out for. It's really too early to comment on what will be the impact on domestic demand, or global demand for that matter. But that is something that does lend some amount of caution in terms of how much we should project growth to improve to in H2 after having seen the Q2 data.
So, the thing about, and you're absolutely right, Aditi, we've been seeing manufacturers across sectors beginning to hike prices, whether it's biscuits, soaps, shampoos, phone bills, everything has gotten more expensive. And let me just take that to D.K Joshi. Do you think that this is going to mar the sentiment further for Q3, even though we're seeing so much conspicuous demand out there? Everyone we speak to, I have spoken to in industry, says that the demand is back, but the supply is perhaps not matching. And now prices will also be going up.
Well, I think there is the demand-supply gap is particularly stark in the high ticket items. I mean, for automobiles, for instance, I mean, where the waiting period is goes up to even 9 to 10 months. I mean, so because I think that's the supply constraint, I think. But I think for a broader consumption, I think there are two kind of patterns that are playing out. I think one is that I think what we saw in the second quarter and what we will also see more in the third quarter is that the services sector in the urban areas beginning to pick up. I mean, and as the services open, I think it does augment the income of lot of people who are associated with these services, and many of them are the lower income brackets. I mean, and then I think if the cut in duties on fuel does play out in terms of lower fuel inflation, then I think all this is a little bit of consumption positive for third and fourth quarters. But I think there is an offsetting factor as well. I think the as was being pointed out, Aditi, also the producers are now cascading the input price increases into retail prices, and this is clearly consumption negative. So there are mixed signals on the consumption front. There is one part of consumption which is doing well. The other part, I think, which is not doing so well. So I would feel that I think the policy still has a larger role to play in supporting consumption, and particularly I think in the rural areas where I think the price effect is not that strong as last year. So I think that hits the rural incomes, and the demand for Manrega is still quite high, which means that the employment opportunities are not that many. I mean, so clearly I would say that there is need to support rural consumption this year. And I think what we are also witnessing in the corporates is that the top lines don't seem to be impacted that much this year, because but if you look at the volume projections, I think what is playing out is much lower than what was projected earlier in the beginning. This is the price effect. I mean, the price is keeping the values of the top lines look good. I mean, actually in volume terms, and they don't look as good.
You know, Mr. Sanyal, the inflation issue, and do you think enough has been done in terms of government support to really boost recovery? What has been done in terms of inflation, and some comfort is an excise duty cut so far, and some of that has been passed on. Hopefully more will on behalf of the states, etc. But other than that, do you think that inflation is going to be a continuing cause of concern, part one? And part two, do you think more could have been done in terms of government support?
That's a very important question. And there are two ways of looking at it. If I see it from a very near term, with a very near term perspective, given that there has been fresh round of uncertainty globally, there is some drop in commodity prices, little bit of strengthening of US dollar, which is typically negative for commodity prices in general. We are seeing some bit of softening in some of the inflationary pressures which were bothering us over the course of the last 2-3 months. So to that extent, it's little bit of little positive. The weather disruptions here at home, what we had been witnessing of late, if we don't see that kind of weather disruption, that is possibly a little better for food inflation. And typically in the winter months, we get some kind of a relief in terms of local food prices. So these factors are a little positive. And as you mentioned, the excise duty cuts, etc., they also should contribute in terms of both direct and indirect effect. But having said that, what is possibly the bigger or the broader theme is that over the last 1 year or so, I mean, after the COVID first wave globally, when recovery started, from that point onwards, we are witnessing series of surprises, which led to supply disruption in various parts of the world, one after another. Some were somewhat predictable, some were absolutely, huge surprise. So those surprises, which are typically negative from a supply side management point of view, had been the norm over the course of the last 1 to 1.5 years, and that remains some kind of a concern. And my sense is that that's a broader theme, even though the very near term looks somewhat more comforting. So it's like this, that even if the near term numbers do not appear that ugly compared to what it had been maybe in the previous quarter, the guard against inflation or the caution against inflation will still remain pretty high. My sense is that policymakers are facing some kind of a very, very difficult situation where there is a continuous need to continue supporting the recovery process, which is still in the early stage, which is still very, very uneven, in certain cases quite fragile even now. But at the same time, it's very difficult for them to ignore inflationary pressures for a very long period of time. So in the near term, it's good that there is some very near term relief. I think at this moment, policymakers will be focusing more on that, but we need to really see what's in store beyond the next 2 to 3 months.
Yeah, we have to see what the monetary policy looks like. Mint Street right now, perhaps really walking that fine balancing line that you're talking about. Aditi, your take on the new variant, Omicron. So it's been sort of seesawing, where yesterday people were feeling, okay, it's not so bad because the South African medical director said that the symptoms seem mild. Today, the Moderna CEO comes and says that, hey, we're going to have to change all of our vaccines. No one really knows for sure. Do you think this uncertainty will already start hampering and impacting at least global growth and by default some of India's recovery as well, at least in sectors like travel, tourism, etc.?
Yeah, I think it's going to be, the cross-border movement which is going to be affected the first, and it's going to be that, the expected revival and tourism flows which are going to get some amount of a setback, at least temporarily. And beyond that, it really is going to depend on what is the level of alarm or panic that is warranted by this variant. At this point in time, we just don't know what is the level of caution that is warranted in terms of this new variant that has emerged. And given the fact that the victories have also been hard won, I don't think anybody wants to rush into a lockdown. At the same time, nobody wants to just sort of be caught napping. It's going to be uncertainty for the next couple of weeks, and I think perhaps it's a good thing that we have the MPC review that's still just about a week away, because at least some additional information may be available, which is meaningful in terms of its usability for projecting the future, the near future. But I think at this point in time, it's best to really be cautious. And despite the fact that today's Q2 GDP data is higher than what we were penciling in, we're actually not changing our full year GDP forecast as of now, because the festive uptrend is certainly there. Q2 numbers were a little bit higher, although, as I said earlier, I am not at all convinced by the internals of those numbers. But given the caution that is warranted because of the uncertainty created by Omicron, we are choosing not to revise our GDP forecast for the full year as of now. And as more data comes in about how we should view global and domestic growth in light of this variant, we will take a call maybe later in December as to what is a more appropriate level of H2 forecast for GDP.
Absolutely. We'll have to wait and watch. And that is why it's important to discuss what lies behind the headline numbers, which we do here on the India Development Debate. Fingers crossed on the new variant not really being a spoil sport and perhaps milder than was previously thought. The big question, of course, is will our vaccines hold up? In fact, a statement from Bharat Biotech came in today saying that they are looking at the efficacy of Covaxin against all variants. They didn't mention the Omicron in particular, but I'm sure that that process will definitely be on. Well, we'll hope for the best. And meanwhile, thank you so much to all of you for joining us on the first debate this evening.